Mr. Yogesh Chetwani has 38 plus years of work experience in the field of finance and indirect taxation and providing services in the field of social audit. He is faculty with various registered valuer organization, IPA, ICAI, Kolkata. He conducted 800 hours of virtual or physical sessions covering a wide range of topics, including valuation, indirect taxation, insolvency and bankruptcy law, general and business laws, social audit, and macroeconomics. He is a CMA, IP, RV. He has also done CPA exam from USA. Mr. Yogesh, we are very happy to know that you also have done NISM certification on alternate investment funds class 1 and class 2 examination, and you also completed NISM social auditor examination. Mr. Yogesh has superannuated as Chief Manager Finance from Indian Oil Corporation Limited in June 2021 after 35 plus years of service. So we are eager to hear from you today all about AIFs. And one thing, like what exactly is this NISM AIF class 1, class 2 examination? Please enlighten us on this as well. Over to you, sir.
Thank you, Silpa madam, for that nice introduction. And good morning to each one of you. Happy morning to each one of you. And first of all, I would like to express my sincere thanks to entire organization team of Bangalore Valuer Association, and my special thanks to Ravi Chandran sir for proposing to me and for inviting me to take this particular session. And my thanks to Vijaya Lakshmi madam and Silpa madam for being instrumental in organization of this particular event. And I will fail in my duty if I don't express my sincere thanks to each one of you, because this time, as Silpa madam informed us, usually we go for our a morning a routine exercise, and today you have skipped that session to join this. So this shows your eagerness for update of professional knowledge. This shows your dedication towards the profession, and that will also increase my responsibility to give as much input as possible on this particular topic. First of all, as Silpa madam told us, so what is NISM AIF examination? So this particular exam is conducted in two parts. First is part 1 and 2, and second examination is part 3. I passed part 1 and 2 NISM exam last month, and just 2 days back, that is on last Thursday, I also cleared my part 2 NISM examination. With that, I have already cleared both the examination. Now, many questions are coming. Why this particular section? Why this particular area of work, or why? What is the purpose behind clearing this examination? So I always believe in a lifelong student philosophy. Actually, I have continuously upgraded myself. Even after retirement, I have passed limited insolvency examination, valuation examination, social audit examination, and these two examination. So whether we will get a return for that in means near future or not, that is immaterial for me. I actually always means appear for this type of examination to upgrade my knowledge. So that is about this examination. And now, since the time is very short, for this wide subject of alternate investment funds. So you will all appreciate that it is having a very wide coverage and a time 2 hour, that is a very short. So what I will do, I will directly go to my PPT. Just give me a minute. I will share my PPT, and during PPT we will discuss many things. So I hope my PPT is visible to each one of you. And if you face any issues in visibility of my PPT, or if I am not audible, so you may interrupt me anytime. And at the same time, if you have any question related to this, please interrupt me so that we have more clarity. Actually, interactive sessions are always interesting session, and we learn from each other. Actually, you all are means experienced professional, and you actually have a better knowledge on some of the areas which will be covered in this PPT. So please interrupt me and share your knowledge. We will take this as a knowledge sharing session, and we always learn from each other. So that will be the motive of this particular session. And a disclaimer first. So I am not actually we registered valuer. We are used to make disclaimers in our evaluation report. So I will also make a disclaimer at the beginning of this particular session. So I am not expert in this field, but whatever I have learned in these two examinations, so I will try and share knowledge on that. This means title of this particular session is Beyond Traditional Investment and Unleashing the Value of Alternate Investment Fund. So this I propose this will be the coverage. So we will start with the preliminary and regulatory provisions relating to AIF and regulatory provisions related to valuation, including a recent amendment. So as we all are aware, after this session was means notified by a BVA during current week, more particularly on a Monday. So after that, SEBI has come out with many regulatory guidelines, including on valuation during a current week in last 2 or 3 days, and that particular circular is also circulated in our group, BVA group. So you all must have gone through that, and these guidelines were long overdue because these AIF regulations were notified way back in 2012, so around 11 years back. But there was no clarity what methodology will be applied for valuation of the assets which are held by AIF, and who will do the evaluation. So it was simply told in the regulation, evaluation will be done by an independent evaluer, but who will be the independent evaluer? So that guidelines were not a part of AIF regulation. So during January, somewhere in January, actually, discussion paper was published by the SEBI on these on issuance of this guideline, and public comments were made. And in SEBI board meeting, which was held in March 2023, it was finally decided that yes, there is a need for more additional regulatory guidelines, including on evaluation and who can become a independent valuer. So finally, that has come during current week, so that we will review. And then a brief about IFSCA Gandhinagar, Gujarat. So as you all may be aware, this International Financial Services Center that is located in a gift city of Gandhinagar, Gujarat, and there actually AIFs, alternate investment funds, these are coming up in a very big way. So we will have a brief on that, and then we will have a fund structure. Particularly, we will review the fund structure of category 3, which is more complex fund structure as compared to category 1 and 2. So we will try and get overview of that, and then a brief on a taxability of the alternate investment fund. So this is what I propose to cover in the next 120 minutes or so. And these particular figures will give you an idea how actually the number of registered AIF in India, SEBI registered AIF in India, that has gone up, particularly after 2020, that is particularly after COVID 2019. So as you can see, we have around 885 registered AIF as at 31st March 2022, and registration of AIF that can come in three categories, that is AIF category 1, AIF category 2, and AIF category 3. Under AIF category 1, we can have infrastructure fund, we can have social venture fund, we can have a venture capital fund, we can have SME fund. So these are the different types of fund which can be set up under the category 1 AIF. And as you can see, the majority are under this particular category. And apart from that, we have category 2508. So maximum share of a registered AIF, that is in a category 2, and a category 3 we have 173. So these total 885 registered AIF that were on 31st March 2020. But if you review the latest information which is available on the SEBI website, then we have around 1138 registered AIF as at 22nd of June 2023. So you can see how actually this number of registered valuer is going up in India, and that may perhaps provide more opportunity to the registered valuer, particularly after issuance of a guideline during the current year. So these are the number, and we will move forward. This is actually a commitment raised and investment made by all AIF. So as per the AIF structure, the investor first make commitments. So a particular investor will make a commitment for investing, say, 100 crore. So he is not supposed to deposit entire amount of 100 crore in one go. So because these AIF ultimately will invest in various financial asset, and these investment opportunity may not come in one go. So as and when actually fund manager, they will see the investment opportunity, they will make a call for that, but that will be out of the commitment made by each investor. So we have three stages. Number one, commitments made by investor. Then a call is made to investor for a deposit of the committed investment in AIF. And once it is deposited, so third stage is AIF will make investment. So this particular chart will give you an idea how actually this investment fund and a committed fund that is gone up from 2020 onwards. So in 2020, as at the 31st of March 2020, we had a commitment of around 3,70,000 crores, out of which 1,53,000 crores were invested by the AIF in various types of financial asset. But if we review the same numbers as at 31st March 2022, so committed fund has gone up to 6,41,000 crores, around 6,41,300 crores, and out of which investment is made to the tune of around 2,84,000 crores. So this will give you an idea how actually the commitment and invested funds is going up year after year, particularly after March 2020. And this is a data related to the cumulative net figure as at end of March 2023. As at this will provide you an idea about commitment made category wise, category 1, category 2, and category 3 in various types of fund. What is the amount of commitment raised, what is the fund raised, and how much investment made out of a fund raised. So category 1, as you can see, we have infrastructure fund. So commitment raised is around 15,600 crores, out of which fund raised is around 5,400 crore, and finally investment made is around 4,700 crores. So apart from that, we have a social venture fund, a venture capital fund, SME fund, and a total number of category 1 that is around 59,000 of commitment made, commitment raised or made, and a fund raised out of that is around 28,000, and investment made out of a fund raise that is around 24,000 crore. And a category two, we have a commitment of around 7 lakh crore, and fund raised is around 2,70,000 crore, and commit of investment made is around 2,40,000 crore. And a category three, so that is having lowest number, around 80,000 commitment raised, and investment made is 71,000. So this category three has not become so popular, but I can foresee going forward in a near future, the number, this amount investment in a category three that will go up considerably, because that gives more flexibility to the investor as compared to category one and a category two. So with that, actually, the total commitment made as at 31st of March 2023, that is around 8,33,000 crore, out of which around 3,65,000 is raised by AIF, and around 3,37,000 of that is finally invested. So as you can see, 31st of March 2022, how actually that has gone up at 1st of March 2023. So that
what is
will
category 2 you want to highlight, because it's like a lot of investments are coming in category 2. Like
yeah. So that we will get an overview of that. What is category 1, what is category 2, what is category 3? That overview we will definitely get out of that, madam. So we will move forward. So this is the instrument-wise deployment of the funds by AIF. So they have given the numbers of this how investment is made. So we can see from here, as at 31st of March 2022, the AIF have made investment of 2,84,000 crore. So how these investment have been made. So this will give you idea. So unlisted equity share and equity linked instrument or LLP interest. So that is having around a 41% share as at 31st of March 2022. And next highest, that is in a debt or a securitized debt instrument. So that is having around a 29% share, and a listed equity, so that is having a 17% share, and other like units of other AIF or a liquid fund or a listed or a to be listed SME exchange, so that is having a negligible share. So this will give you an idea how funds are deployed by the, or how funds are invested by the various types of AIF, that is a category 1, category 2, and a category 3. So this is what is a sector-wise deployment. So you may be interested to know which sector actually getting funds from various categories of AIF. So as you can see, the major chunk is going to the real estate sector, which is having around a 21% share, followed by banking and financial services, so that is 11%. Service sector also around 11%. And then we have a pharma, NBFC, FMCG, retail, energy, and others. So apart from IT and IT services. So this is actually a sector-wise deployment of funds by AIF. And this is the Gift City IFSC. So a Gift City IFSC actually having a two, it is divided into two parts. Number one, a DTA, and number two, ACZ. So a more flexibility to invest is in ACZ of Gift City IFSC. So there actually investment needs to be made in a foreign currency, particularly in a US dollar. So this is actually a category-wise number of funds and a corpus as at 31st of March 2022. So as we can see, the category 1 and 2, that is a number of fund registered with IFSC, that is 10, and a corpus is around 4081 million US dollar, and a category 3 is having around 14 funds and 1072 million US dollar, and a total commitment or a corpus which AIF registered in IFSC, they have around 5,100 million US dollar. So that is the scenario in a gift city, and a gift city going forward will become more attractive because there are various tax concession which are attached to getting registered in IFSC, and means this is a recent development. As you all may be aware, this scheme was notified by the central government just in 2020. So that is 3 years back, around 2.5 to 3 years back. So going forward, this number will go up, and it is said that the professional will get ocean of opportunity in a gift city, that is IFSC Gandhinagar. So this is investor plan.
1 minute.
Yeah, please go ahead, madam. Please go ahead, madam.
Sir, for the benefit of all the members here,
Yeah.
if you have some material on the gift city, because the numbers are really, impressive, and that too you're sharing 22 numbers. So I can imagine how the numbers of 2023 could be. So if you have some material on this gift city, like since you're already done so much of, research, that also you can share along with this PPT. When you're sharing this PPT, material, because this is something which all other BVI members also, everyone wants to know everything, but we don't know where to search. It's not just about Googling, right, sir? It's about knowing the right information in the right place, which is relevant to us.
Very true, madam. Actually, I got opportunity because I am residing in Ahmedabad, Gujarat. So that is located just a few kilometers away from my residence, and actually I have visited that several times. So I would, apart from this PPT, because as you can see in a coverage itself, I have actually incorporated brief about IFSCA Gandhinagar, Gujarat. So apart from that, I will also share some other material which may help the members of this association. So that I will definitely do, madam.
Because in the background, each one of us is either a CA or a CS or a CMA, and then that profession also, this is like very much relevant. So this request.
I know. I will definitely do it, madam. So that I will definitely do. So that is about investor plan to allocation of alternatives by 2025. So this is on a global basis, how actually investor plan to their a plan for their allocation to AIF by 2025. So in India, actually, we the retail investor, we majority of we all are actually, in fact, not majority, we all are actually a retail investor, and we do not get opportunity to make investment in AIF. But particularly in a USA or a European country, there is a concept of liquid alternative. So that actually, by doing that, a retail investor also are entering in investment to AIF. So we will get detail of that during this PPT. But actually, that is a recent development, and going forward, that will have a more pooling of investment from the retail investor. So this survey was done by this renowned firm, Preqin Investor Survey, and this was conducted in August 2020. So according to finding of this survey, actually 55% of the participant of this particular survey, they believe that the allocation to alternatives by the investor that will go up. So 55% of that believe that 55% of the means a participant of this particular survey, they believe that it will go up, and we have these 26% other participant who believe that that will increase significantly. So as you can see, a majority of the participant of this survey, they believe that investor allocation to alternative will go up significantly by 2025. So that will actually give us overview of the opportunity available in this particular area. And this is actually the alternative asset under management. So that is we call it asset under management. This is 2010 and 2026 forecast. So this is 2021 and 2026 forecast. We have a 2021 actual numbers and a 2026 forecast number. These will actually finding of this survey will highlight that the investment in equity that will go up considerably, and that will go up around more than a 10 trillion US dollar, and that will be followed by private debt, hedge fund, real estate, infrastructure, and various types of natural resources. So this is the forecast, and this will again give you an idea how actually the future of AIF will shape going forward. So that is about projections in investment in various types of avenues. And this is absolute alternative asset or growth between 21 and 2026. So as we can see, it is expected that this means growth in Asia Pacific countries. So that will be around 100%, followed by in North America, which will be more than 100%. And then we have Europe, rest of the world, and a diversified, mutual, multi-regional. So this will actually give a region-wise idea about growth in this asset under management or alternative asset under management. And these we all are aware, these are the traditional investment avenues. So we invest in a fixed income security like a GSEC or bonds or debentures and all. We also invest in equity, mutual fund, a derivative, real estate, a commodity, a money market instrument. So all these are traditional investment avenues or opportunities available. But these actually retail participation in these investment avenues is on higher side, and these avenues are more or less thickly regulated, and the return on this because the investor in these are risk averse, so they would actually prefer safety of their funds. Naturally, we have a concept of more risk, more return, or no risk, no return. So here, actually, in traditional investment avenue, the risk taken by the investor, that is minimal. So returns also will be minimal. So what we get return that will be around 7 to 13 to 14%. And if we adjust this a return of 7 to 14%, a nominal return of 7 to 14% with the inflation number, so real return may be very less. And that is the reason why the institutional investor like pension funds and all, or the sovereign funds, or the high net worth individual HNI, they actually seek for a more return. They are actually a risk-loving investor. They actually would like to take a more risk. They would prefer illiquidity over liquidity, meaning that they would like to invest for a longer duration. And but one thing they expect in a return, that is more a return. So traditional investment avenues, these are not means considered favorable by these type of institutional investors or the high net worth individuals. Any questions, sir? Srikant, sir, any questions, sir? Shrikant sir, may I request you please mute, sir? Shilpa madam, are you there? May I request to mute Shrikant sir? I am not having that rights. So I will actually. Is there anybody from organizer? May I request all participant please mute whenever you are not talking. If you have question, you are free to unmute yourself anytime and ask your question. But otherwise, I would request each one of you please mute yourself. So these are the traditional avenue, and this is about the need for alternating investment fund. So this is a brief about unlocking of opportunities in alternate investment funds. So these funds provide opportunity to diversify the investment portfolio beyond traditional asset classes like a stock and bond, and they provide exposure to a wide range of alternative asset like private equity, hedge fund, real estate, commodity, and more. And these type of fund can also help to manage risk by spreading the investment across different asset classes. So presently we have two types of investment, mainly two types of traditional investment opportunity, where there is a concept of pooling of fund, that is a mutual fund, and the portfolio management services. So in a mutual fund, as we all are aware, they actually means invest strictly according to the objective of the fund. So that will not provide the flexibility to the fund managers to deviate from the path of a predefined investment strategy. But in AIF, actually, the fund manager, they will get more flexibility. And portfolio management services, as we all are aware, that is assets are held in the name of individuals. So that will give less flexibility to the fund manager. So these solution for that, or answer for that, is AIF. So that will help manage risk by spreading the investment across different asset classes and deploying of various strategy. And these diversification that can potentially reduce the impact of market volatility and economic downturns on the overall portfolio. And these alternative investment, this can frequently have the potential for higher return as compared to the traditional investment. So as we already discussed, more risk you take, more return will come. So that is the concept universally accepted in finance. So here actually the investors of AIF, they naturally take more risk. So they will be entitled to more returns also. So these fund will allow access to investment opportunity that may generate attractive risk-adjusted return, and particularly in a sector or a strategy that are not easily accessible through a traditional investment vehicle. So as we already discussed, like a mutual fund. So mutual fund, it is a mid-cap fund. So that will invest only in a mid-cap. And they will actually have, they are actually allowed to play on a long only. They cannot play on a short strategy. So that is the limitation because that is more regulated. But in AIF, the investment managers will give more flexibility, and that will actually give a more risk adjusted return also. So this AIF, these are managed by a professional fund manager who possess specialized knowledge and experience in a specific alternative asset classes like hedge fund, equity fund, social fund, or a venture capital fund and all. And investor can benefit from their expertise as the fund manager conduct in-depth research and analysis to identify a promising investment opportunity. So that is the AIF, and continuing with that, so AIF typically have a longer investment horizon compared to a traditional investment fund, and these longer term approach that will align well with certain alternative investment like private equity and real estate, which require time to generate a return and may have a limited liquidity. So these are the reason for why actually these are the reason for investor look for investment in EIF, and these funds can also provide a hedge against inflation and a market downturn. So a certain asset classes like commodity or a real estate that have historically shown resilience during a period of economic uncertainty, offering a potential protection to the investors' portfolio. And these funds can also be structured to get specific investor preferences or objective. So there are many alternative investment funds. These are focused on environmental, social governance, or ESG principle or impact investing, allowing investor to align their investment with the value. And of course, these AIFs are subject to regulatory framework. So in India, we have SEBI Alternative Investment Fund Regulation of 2010. So that will actually provide investor protection and transparency, but that will be actually very limited because this AIF, that is investment in AIF is made through a public, not a public placement, that is made through private placement. So once it is a private placement, so that will actually reduce the transparency, and certain matters will always remain confidential from the perspective of the general public. So this regulatory body set guideline and monitor AIF to ensure compliance, enhancing investor confidence in these investment vehicles. So that is the reason actually from time to time SEBI in India actually notify amended guidelines on management of AIF, and means multiple guidelines have also come during the current week. So what is the meaning of AIF? We all would be interested to know. So that is provided in a regulation 2 of SEBI AIF regulation. So if we go by that, so this AIF, that means a fund which is established or incorporated in India. So means recognition will be there only if it is incorporated or established in India, and a form of AIF that can be a trust or a company or a limited liability partnership or a body corporate. So that is means, in other words, individual or a proprietorship or a partnership, they cannot get incorporated or registered as AIF. And India actually, this majority of the AIF, they have registered themselves, or they have established themselves under a trust. So that is the form of AIF which is widely accepted in India, a trust, because trust, as we all are aware, that is a pass-through entity, and so that will give a more advantage to the investor. But going by the definition of means this AIF in Income Tax Act, so only class 1 or category 1 and category 2 AIF that fall under that meaning or a definition. So the category 3 actually having less tax exemption as compared to a category 1 and 2. So means this AIF is a privately pooled investment vehicle. So that is not a publicly pooled investment. So privately pooled investment vehicle which will collect funds from investor, whether India or foreign. So investor can be in India or in foreign countries as well, for investing in accordance with a defined investment policy. So in a private placement memorandum, or we call it as a PPM. So in a PPM, a fund actually define their funds are supposed to define their investment policy for the benefit of its investor. And This AIF, it is made clear that that is not covered under a SEBI mutual fund regulation or a SEBI collective investment scheme regulation or any other regulation of the board, including the means venture capital regulation or to regulate and management services. So following shall not be considered as alternative investment. So these are the exceptions. So a family trust set up for a benefit of relative that cannot become a AIF. Similarly, ESOP trust, employee welfare trust, or a gratuity trust set up for the benefit of employee. Holding company as defined under a section subsection 46 of section 2, so that cannot become AIF and other special purpose vehicle not established by a fund manager, including a securitization trust regulated under a specific regulatory framework. So these are the exceptions, and funds managed by these means ARC, Asset Reconstruction Company, which are set up under a Surface Act, so that they also cannot become AIF. And any such pool fund which is directly regulated by any other regulator in India, so that will not come in the purview of AIF. So that is about the meaning of AIF, and we have seen actually these AIF are divided into three category. So as Silpa madam told us, so what is category 2, what is category 1, so that we will see in a brief. So this category 1, these are a close-ended fund. Means having a minimum tenure of 3 years, and they are investing in ventures that are ideally considered as economically desirable. So which are those ventures? We will go through a list of that. But primarily, the category 1 funds are set up for ventures that are considered economic desirable to the country. And naturally, when it is economically desirable to the country or economy, when it is in the interest of a company, they will enjoy a certain additional tax concession, additional benefit. So that is a category 1. And a category 3, we will first see the meaning of category 3, because category 2 is in residual in nature. Which are not covered under category 1 and category 2, that will come under a category funds which are not covered under a category 1 and a category 3. So those funds will fall under a category 2. So category 2 is residual in nature. We will now see the meaning. That is the reason we will now see the meaning of category 3. So these are open-ended or a close-ended fund. That can be both open-ended and a close-ended. So remember, category 1 and category 2 are close-ended fund. So they have a defined tenure. But category 3, there is a flexibility. Either it can be open-ended or it can be a close-ended funds also. And that will employ diverse and complex trading strategy with a view to gain a short-term return. So managing a category 3 AIF, that is more challenging as compared to a category 1 and a category 2. And since it is open-ended fund, so a registered valuer get more and more opportunities because as per SEBI regulation, the valuation, these means the valuation of financial asset held by category 3 AIF, open-ended category 3 AIF, that needs to be filed with SEBI on a monthly basis. So apart from that, wherever it is a listed investment in a listed security, so valuation of that will be required on a daily basis. So here actually there are more opportunities for a registered valuer as compared to a category 1 and 2. So category 3 can be open-ended and a close-ended fund employing diverse and complex trading strategy with a view to gain a short-term return. So that is category 3, and category 2 is residual in nature. So that is close-ended fund having a minimum tenure of 3 years and which do not fall under a category 1 and a category 3. So that is the brief about these various categories, and we will review it further, learn about it further. So just give me a minute. So this is the category wise types of AIF. So under a category 1, we can have a venture capital fund. We can have angel fund, which is a subcategory of venture capital fund. Then we have an infrastructure fund. We have a social venture fund, and we can have a situation specific fund. So these situation specific funds is a new development under AIF regulation, and the situation specific fund can also become resolution applicant under IBC under IBC 2016. As we all are aware, under IBC there are various processes, and one of the process is CIRP, Corporate Insolvency Resolution process. So what is CIRP? If we describe that in one word, so that is insolvency resolution through ownership transfer. So ownership transfer is involved. So these AIF can also become means particularly this situation specific funds under a category 1. They can also become a resolution applicant, and they can take over a company which is in a finance, which is in a distress, and subsequently, if they get opportunity, they can again sell it off. So that is a situation, a specific funds. One of the examples of situation, a specific fund. Apart from that, there are many other situation. Category 2, we can have a debt fund, a private equity fund, and a funds of fund. So funds of fund will invest in various types of fund like a debt fund, a private equity fund, or a venture capital fund. So they will they are having flexibility to invest in various types of fund. So once it is becoming a funds of fund, so naturally fund manager will be multiple, not one, and they can actually that will come at a cost because the management fees that will go up. So as I can see, Nikki madam has some query. Madam, you have raised your hand. So any question, Nikki madam?
Yes, sir. Thank you so much for the content till now, sir. Sir, wanted to understand if you can just also throw some light on difference between the funds and the schemes which these funds will be running under the AIF categories.
So that is a part of my this PPT, madam. If you want,
Thank you so much.
If we want, we can go that now. But if you allow,
your choice, sir.
So we will cover that, madam. That is a part of my PPT, and yeah, that will come means in a few minutes from now. So a category 3, these are a hedge fund and means private means a private investment in a public entity funds. So mainly it is a PIPE or a private investment in a public entity. So as we all are aware, these category 3 that can become actually means a pre-IPO. Certain category of investors are allowed to invest. Like qualified institutional means buyers, so that AIF 3 will fall under that category. So that is actually one type of investment, and another is they can also invest in a public and listed entity or a listed company or a public entity. So that is a private entity, and we will see in a more detail. And this is the meaning of category 1 as per regulation 34A of SEBI AIF regulation. So means what is a category 1? So that will invest in a startup or early stage venture or a social venture or SME or infrastructure or other sector, as we already covered, or areas which the government or regulator consider socially or economically desirable, and shall include a venture capital fund, SME fund, a social impact fund, infrastructure fund, a special situation fund, and such other AIF as may be specified. And these for the purpose of these clause, the AIF which are generally perceived to have a positive spillover effect. So that is the philosophy of category 1 AIF. So that should have a capability to have a positive spillover effect on economy, and for which the board or government of India or other regulators in India might consider providing incentive or a concession, and that shall be included as such funds which are formed as a trust or a company, and shall be construed as a venture capital company or a venture capital fund as specified in Income Tax Act of 61. So as I told you, under this section 10 of Income Tax Act, the means funds which are recognized, that is a category 1 and a category 2, and they are entitled to a certain tax concession. So that is the meaning of category 1, and a category 2, the IIF that will does not fall in category 1 and 2, 1 and 3 rather. So as we discussed, that is a residual in nature and which does not undertake leverage borrowing. So a very important the leverage that entitlement is to only a category 3 AIF. So category 1 and category 2, they are not entitled for any leverage, and that leverage can be in the form of borrowing from a banks or a financial institution, or a leverage can be in the form of exposure, whether it is means sorting, or whether it is taking means exposure in various types of financial derivative. So category 3 AIF are only entitled to take the leverage. Otherwise, a category 1 and a category 2, they are bound to invest from the fund collected from the investor, with the exception that they can borrow money means to a certain extent as per the guidelines issued by a SEBI, purely for meeting the administrative expenses. So they cannot create leverage for the purpose of investment. So that is the another condition. So category 2 does not undertake leverage or borrowing other than to meet a day-to-day operational requirement and as permitted under these regulations. So for the purpose of these clause, AIF such as private equity fund or a debt fund for which no specific incentive or a concession are given by the government or any other regulator shall be included. So the private equity fund or debt fund which have a specific incentive that will be part of category 1, and the funds who do not have a specific incentive or a concession that will be covered under category 2, and category 3 that will employ diverse and complex trading strategy and may employ leverage including investment. So this leverage, actually there is a upper limit that cannot be more than 2 times of net assets of the category 3 AIF at any time. So that is the threshold or the upper limit for creating the leverage. So that leverage, including through investment in listed or unlisted derivatives. So as I informed you, that leverage can be created through exposure in either listed or unlisted financial derivative. And for the purpose of these clause, so AIF like a hedge fund or a funds which trade with a view to make short-term return, or such other fund which are open-ended and for which no specific incentive or concessions are given by the government or any other regulator, that will be included under a category 3. So these are the conditions related to investment in AIF. So AIF can raise a fund from any investor, including Indian and a foreign non-resident Indian. So that is these I have taken from regulation 10 of SEBI AIF regulation, and each scheme of AIF must have a minimum corpus of at least 20 crore rupees. So that is the minimum corpus which each AIF should have 20 crore rupees, and for a social impact fund, so a minimum corpus is of 5 crore rupees. And as we all are aware, recently SEBI has actually amended ICBR for creation of a social fund, including a social impact fund. So minimum corpus for them, that will be 5 crore, and AIF cannot accept an investment of less than 1 crore rupees. Because of these conditions, the retail investor like us, we cannot even actually imagine for investment in AIF. But as I told you, going forward, the concept of a liquid alternative may come in India, because that is already prevailing in foreign countries at present, and that may make our participation in AIF possible. But at present, that is 1 crore rupees. As we all are aware, in a portfolio management services, the minimum investment is 50 lakh. Here it is 200, means double of that 50 crore, 50 lakh. So that is 1 crore rupees. So AIF cannot accept an investment of less than 1 crore. In a PMS portfolio management service, it is of 50 lakh. And for employee or a director, there is a relaxation. So a minimum investment for them is 25 lakh rupees. And another is accredited investor are exempt from these requirement, because for accredited investor, the minimum investment is around 70 crore rupees. So that is how they get that status. And for a social impact fund, investing in a security of not for profit organization which are listed on a social stock exchange. So a minimum investment is 2 lakh. So this is about the condition. And continuing with it, so a manager or sponsor of the AIF must have a continuing interest in the fund of at least a 2.5% of the corpus, or a 5 crore rupees. So it is not that a fund manager will be independent of the fund. He will one of the investor in the fund. Then only he will realize his responsibility to generate a return. So that is a concept in this. So a fund manager or a sponsor of the fund, they will actually become a co-investor. For category 1 and 2, they should have a minimum investment of at least 2.5% of the corpus, or a 5 crore rupees, whichever is lower. And for category 3, that limit is 5% or 10 crore rupees, whichever is lower. And another condition is these interests must not be in the form of investment in AIF, and that cannot be through of, must be in the form of investment, and cannot be through a waiver of management fee. So actually fund managers, as we all are aware, they are entitled to a certain management fee. So what they will, fund manager may say, I will make investment through waiver of my management fee, but that is not permitted. And the manager or sponsor must disclose their investment in AIF to the investor, and no scheme of the AIF can have more than 1,000 investors. And if AIM is formed as a company, so provision of Companies Act will apply. And a fund can only solicit and collect fund through private placement. So public placement is not allowed for AIF. It is only through a private placement. So when it is a private placement, that will be through issuance of a private placement memorandum. As in public companies, it is a prospectus. So here it is a private placement memorandum, a PPM. And going by provisions under regulation 11, these information needs to be incorporated in a PPM. That is a routine in nature, all material information about AIF and the manager, then background information about the key investment team and of the manager, targeted investor fees and other proposed expenses, tenure of the AIF. So all these are actually a usual means usual information that needs to be incorporated in any type of document seeking investment. So that is about information to be incorporated in a PPM, and guidance on that is provided under Regulation 11. And this is the tenure and listing of AIF. So guidance on that is provided under Regulation 12 and 30. So category 1 and 2 AIF, these are close-ended and their tenure is determined at the time of application. But a minimum is a 3 year, maximum there is no limit, but that needs to be close-ended, number one, and a tenure needs to be decided in the beginning. And category 3 AIF, this can be either open-ended or a close-ended. And a calculation and a modification of the tenure of a close-ended scheme of AIF that will be specified by the regulatory body. And this tenure of close-ended AIF that can be extended up to 2 years with approval of a third of the unit holders based on their investment value. And a large value fund for accredited.
I'm very sorry. 1 second, I had one query, sir.
Yeah, go
When
ahead,
you
madam.
say when you say there is a tenure for the AIF, and generally we see an AIF apply for a certain limit, saying that they're going to raise investments up to such and such an amount. Now,
Okay.
If they fail to do so, does it work something like an IPO that if they don't raise minimum of so much percentage, then it has to be returned or something like that?
Yeah, those provisions are not there specifically, but actually means as you rightly pointed out in public issue, there is a certain threshold for a minimum collection of fund or a minimum investment. But those type of actually guidelines are not there, at least in this, because means a majority of the cases they are successful in investment, but a specific guidelines under AIF regulation is not there, madam. So what is the minimum investment that needs to be collected by a AIF, and how it will be dealt with if that minimum investment has not come? So those type of guidelines are not there specifically. Probably, actually, they have not visualized that eventuality, or they have not given a reply to that in at least in a regulatory guidelines, madam. As far as I know.
Okay. Thank you, sir.
Thank you. So the tenure of close-ended AIF that can be extended up to 2 years with the approval of two-thirds of the unit holder based on their investment value. And a large value fund for accredited investor, they may have option to extend tenure beyond 2 years, subject to a specified condition. So that is about the means tenure, and about a listing. So unit of close-ended AIF, whether it is category 1, category 2, or category 3, that can be listed on a stock exchange. So initial investment is through private placement, but there is a scope for listing on stock exchanges, and that is only for close-ended AIF, not for open-ended AIF, and with a minimum tradable lot of 1 crore rupees. So that is the minimum actually investment requirement. So in AIF itself, a minimum investment requirement is 1 crore rupees. So once it is listed, so a tradable note will also be of 1 crore rupees. And a listing of AIF unit, that is only allowed after a final close of the fund of the scheme. So during actually the process of collection of fund, the listing cannot be done. So a tax implication, Sasank sir, that will a different that will be a different for actually means whether it is in category 1, category 2, or category 3, and that is very wide. So they can actually either be taxed under the head of income from a business and a profession, or that can actually be taxed in income from a capital gain. So capital gain, as we are aware, that is divided into two categories again: short-term capital gain and long-term capital gain. and that can also be covered under income from other sources. So type based on a type of asset that taxability will be there. And in case of category 1 and 2, particularly, as I informed you, these are a pass-through entity. So at first level, only income from business and profession will become a taxable. And then at the time of liquidation of the fund, or at the time of a distributor during the tenure of fund to the investor, so that will actually be taxable at individual level, and that can actually depending upon the category of financial asset, that can be covered under a capital gain, or that can also be covered under income from other sources. So that is a tax implication, sir. That is a very wide in nature. I have tried to cover actually brief about that at the end of this presentation. And there are a certain tax exemption specifically to the IFSC in Gandhinagar. So that we will actually try to cover a further detail of that at the end of this presentation. So I hope that will give a reply to your query, Sasank sir. Any further questions, sir? Okay. So units of close-ended, so a listing of AIF, that is only allowed after a final close of the fund. So it is not that the collection, whatever the investment or a collection, that will be done in one go. So that will actually reply partly to Michaeli Madam's query also. So in IPO, actually, all investment is supposed to be collected in one go, but in AIF, there is a flexibility that can be collected over a tenure of the AIF. So that can be in multiple rounds also, not there in one round only. It will be collected, and then it will be ascertained whether that minimum threshold is achieved or not. So that may be the reason perhaps the guideline of that sort is not incorporated in AIF regulation. And this is the brief about the hedge fund. So that will probably give a reply to the query of Nikki Madam. So what type of investment strategy they this AIF employ. So we all are familiar about the strategies in investment in a venture, what strategy actually adopt a venture capital fund or angel funds and all. So we will not go into the usual strategies which are adopted by the means funds like venture capital or angel fund or infrastructure funds, etc. But more particularly this hedge fund. So traditionally we actually what meaning we have about hedging. So hedging is actually set off of a risk, but here actually the meaning of a hedge fund, that is different. So we will go through the meaning of hedge fund. So that is a investment vehicle that pools fund from investor and employs various strategy to generate high return. So hedge fund are typically privately managed and are open to institutional investor and accredited individual. So they aim to generate a positive return in various market conditions, including both raising and falling market. And hedge fund have more flexibility as compared to traditional investment fund in terms of investment strategy, asset classes, and risk management technique. And they can invest in a wide range of financial instruments like a stock, bond, commodity, derivative, and alternative investment. And these funds can frequently utilize leverage also. So as I informed you, a leverage can come in the form of borrowing money, or that can come in the form of exposure in various types of financial of derivatives, but the limit for that is 2 times of the net assets of the AIF on a particular date. And if they breach that threshold, so they are supposed to make good that within 2 days, and intimation about that need to go to the investor and the regulatory body, that is SEBI. So many actually conditions are there, and these are actually a very wide subject. So they can utilize leverage and derivatives to amplify a return or hedge against a potential losses. So which flexibility is not there to traditional investment avenue like the mutual funds or the portfolio management services. So here actually fund manager has that flexibility, and hedge fund manager have ability to take both long and short position. So in a mutual fund, it is only long, but short position is not possible in a mutual fund investment. But here hedge fund both long and short position, which will allow them a potentially profit from a falling prices or a market downturn. So they can in a way safeguard also, as we all are aware, there are many strategies for investment in a financial derivative, and these fund managers are expert in that field. So they continuously monitor the market and they alter their strategy on a real-time basis. And a performance fee, which is frequently called as a carried interest. These are a common compensation structure for hedge fund manager, and they typically on a percentage of the profits generated. So that will give a motivation to the fund manager. In a mutual fund, actually, mutual fund manager or portfolio manager, they will get only a fees which is agreed in the contract at the time of entering the contract. But here actually, if performance is good, if fund managers are actually capable of improving the fund, so that they will get more financial reward. So that is actually a good thing about this. And these hedge funds are known for their active management style, which will involve making frequent trades and taking advantage of short-term market inefficiency. And due to their complex strategies and higher risk profile, so hedge funds are generally limited to sophisticated investors who can bear the potential risk and volatility. So that is about the hedge fund, and these are the various types of strategies which actually hedge fund employ. So we have long short equity, so that will involve taking long position in undervalued security, which is expected to raise in a value, while simultaneously shorting overvalued security, which are expected to decline. So this is long short equity. And a goal is to generate return from both rising and falling market while reducing overall market exposure. So that is long short equity. Then we can have event driven. So event driven strategy will focus on taking advantage of a specific corporate event like a merger, acquisition, restructuring, or a bankruptcy. And a fund can seek to capture a price discrepancy before or after these events occur, and aiming to generate a profit from the event's impact on involved security. So that is event driven. And then we have a distressed debt. So that fund invest in the debt of a financially troubled company or a distressed asset, and they can aim to profit from potential recovery or a restructuring of the distressed security as a company improves its financial situation or undergo bankruptcy proceeding. Then we have a global macro or a macroeconomic strategy. So global macro fund take position based on macroeconomic trend and event like changes in interest rate, geopolitical development, or economic indicator, and they aim to a profit from a large scale market movement across a different asset classes, including stock, bond, currencies, and commodities. And then we have arbitrage strategy. So that will involve exploiting a price differential between a related security or market. So convertible arbitrage, that is one of the strategy under this, and that will aim to profit from pricing discrepancy between a company's convertible bond and its underlying equity. So that they will actually deploy that to work out that is not a easy task. And so that they will actually deploy a quantitative model to identify a mispriced asset and take advantage of short-term price discrepancy. And then we have managed future, so that will trade in future contract or future contracts only across various asset class, including commodity, currency, and indices. And they trade. They use trend following a systematic strategy based on a technical analysis or quantitative model to identify and capitalize on a price trend. Then we can have a multi-strategy, so that will combine multiple hedge fund strategy with a single portfolio. So fund manager allocate a capital across a various strategy. Like actually, if the fund manager has flexibility to invest 100 crore, so they can allocate 25 crore to arbitrage, 25 crore to long short equity, 25 crore to event driven, and they will actually employ expert in all this strategy who will continuously seek investment opportunity, and at the end the fund manager will decide. So that is multi-strategy. Yeah, please go ahead, madam.
One request I want to make. Considering the paucity of time, okay. You want to skip this and move on, because I want to give some time for the Q&A session. Because many of them could be
I know.
Yeah, you can skip this and proceed to the next topic and have some time for Q&A.
Okay, I will do that, madam. But since Nikki madam specifically asked for this type of strategy, I was covering that. So Nikki madam, probably you got your answer. Any further query, madam?
No, sir. Thank you.
So this is a valuation. So more interested in a valuation. So
yes,
in the recent,
that is what I was
in the recent past, actually, as during this week only guideline had issued. So this is regulation 23 of SEBI AIF. So this AIF must provide its investor with a description of its valuation procedure and a methodology used to value its asset. So category 1 and 2 are required to have their investment valued at least once in every 6 months, and evaluation must be conducted by independent valuer appointed by the AIF. So as I told you in the beginning, who will be the independent valuer who can act as independent valuer? That clarity was not there, and that has come during the current week. And with the approval of at least 75% of investor, this valuation period that can be extended to 1 year. And category 3, they must ensure that a calculation of net asset value or NAV that is independent from the fund management function, and NAV must be disclosed to investor at interval not longer than a quarter, or for a close-ended fund. That quarterly is for close-ended, and for open-ended, that is on a monthly basis. So that is category 3. There is no scope for open-ended fund in category 1 and category 2. So open-ended fund can be created only under category 3. So a question will come, which is the best investment opportunity in a close-ended or in open-ended? So naturally it is open-ended, because open-ended, the fund manager will actually continuously monitor the performance of the fund in order to get more investment. Whereas a close-ended fund, so once investment made, threshold achieved, so actually there will not be motivation to fund manager to improve upon the fund from the point of view of getting more investment. So from the point of getting more investment in the fund, open-ended funds are more beneficial, because if means performance of open-ended is not good, so investor have opportunity to exit also from the open-ended fund. So both entry and exit is at choice of the investor, so that will actually give a more better performance. So open-ended and closed-ended, and this is the role of independent valuer in evaluation of assets held by the AIF. So we will skip that. We all are aware about what is the role of independent valuer, but this is the actually important. This is from actually consultation paper on a standardized approach to valuation of investment. This actually was published on 6th of January 2022. Senthil Kumar sir, yes, that is going by the actually clarification given by SEBI just 2 days back, sir. So that is we will cover that, sir. That is means next slide from this. So you will get your answer. So whether only RV is permitted to valuation or any other professional can do this. Unfortunately, it is not the only the RV. Since this question is asked repeatedly, what I will do, I will skip to that. So this is actually the circular. So this is a circular issued on 21st July, 21st of June 2023. So just 2 days back. And here you will get the manner of valuation of AIF investment. So in terms of regulation 23(1), so AIF are inter alia required to carry out a valuation of their investment in a manner specified by a SEBI from time to time. So in this regard, following is specified. So valuation of security for which valuation norms have already been prescribed under SEBI mutual fund regulation that shall be carried out as per norms prescribed by a mutual fund regulation. So actually here my observation is, my preliminary observation, I have not gone into details of this, but my preliminary observation is actually sir, who else can do AIF valuation? Yes, I am coming to that. That I have skipped the previous slide and come to that. You will get your answer shortly, sir. So actually, my preliminary observation is actually we all have got registered under the provisions of Companies Act or Companies. Yeah. So means that you will get your answer, sir. Just allow me 2 minutes. Actually, my first we will go to that who can do the valuation, then we will come to that. So this is the eligibility criteria for independent valuer. So in terms of regulation 23(4) or a sub-regulation 4 of regulation 23, the manager shall ensure that AIF appoints an independent valuer which satisfies the criteria specified by a SEBI from time to time for evaluation of investment portfolio of AIF. So in this regard, following specified. So independent valuer shall not be an associate or a manager or a sponsor or a trustee of the AIF. So generally, actually, what is happening, all these applications of application for a registration of AIF that is filed by the merchant banker. So that needs to come through a merchant banker, and a merchant banker will also responsible to give a reply to queries raised by a SEBI from time to time. So in a way, directly or indirectly, that will become associate of the AIF, and that is perhaps the reason why they have not been merchant bankers. SEBI recognized merchant bankers. They are not actually under the list of independent valuer going by this circular. So that is the first condition. Independent valuer shall not be an associate of a manager or a sponsor or a trustee of the AIF. That is number one. And independent valuer shall have at least 3 years of experience in valuation of unlisted security. Now I am not aware why this is actually this condition has come, a valuation of unlisted security, because the investment of AIF that is not limited to only unlisted security. AIF can invest in a financial derivative investment, can be made in foreign exchange currency or in a foreign currency. It can be made in various types of commodities. It can be made in various types of financial derivatives. So why this particular unlisted security? So that can be listed securities also, that can be commodities also, but that is the guideline, and perhaps that may be actually. Please scroll the site. Does not Angel Network require AIF registration? So that will fall, Angel Network, they will fall under category 1. So if they list, they can very well take the registration category 1. We have covered that. So angel funds are subcategory of the venture capital funds, and they can very well get registration under AIF.
Sir, not angel funds. I'm talking about angel networks. So we have this Mumbai Angel Network, Bangalore Angel Network. So they basically like a pool of investors and companies, and they facilitate the transactions. They don't actually invest into this.
So what type of composition is there, sir, of that? I mean, sir, you will
It is
take
basically
the
a
investment,
marketplace. Yeah, it's basically like a marketplace where.
but is that regulated under some regulation, or that
That's
is
what
a
my
private?
question is actually, because I was deliberating with one client who wanted to start this network in my area, and so we were not sure whether any such approval or this thing is required or not. So networks
That-
actually, it's like a
that-
marketplace of investors as well as companies. So they approach each other and they interact with each other and then decide. And network
But
charge
that-
some facilitation fee.
But that should be registered actually. You cannot do, because some if means some disputes come, then how it will be resolved? So that will always become a question mark, sir. And even e-commerce are regulated. So e-commerce platforms are also regulated. So
No,
how
but these
that
are
can
not
be
again
unregulated?
funds, they do not collect money from anybody. Suppose there is any startup which is looking out any
But
investment.
you are providing infrastructure, you are providing a platform for that, sir, for make investment
But
by
this
one
platform is only
party.
to connect the investors one to one. Basically, like there may be 5 investors who are interested. So investors will set up a separate LLP, only 5 of them, and then they will invest through that LLP. So we do not have any control or investment in that investment arm like LLP.
I know, sir, but better you check with some expert. I am not familiar with those kind of arrangement. Better with some expert. But my primary observation, I have not gone into detail, but my primary observation that needs to be regulated, sir, and some type of registration will be required. But at this point of time, I am unable to give a specific reply under which authority you need a registration.
All right.
So I hope that is clear.
Yes.
And this independent valuer shall not be an associate of a manager or a sponsor, a trustee. That is condition number 1. And then this is the condition. I have at least 3 years of experience in evaluation of unlisted security. An independent valuer shall fulfill one of the following criteria. So this is the criteria. Independent valuer is a valuer registered with the Insolvency and Bankruptcy Board of India and has a membership of Institute of Chartered Accountant of India or Institute of Company Secretaries of India or the Institute of Cost Accountants of India or a CFA Institute or the independent valuer, that is valuer is a holding company or a subsidiary company of a credit rating agency registered with SEBI. So by doing this, actually, probably in India, they have created a new class of valuer because we are familiar with a merchant banker acting as a valuer. We are familiar with practicing chartered accountant acting as a valuer or the cost accountant acting as a valuer. But here it is a totally different new class, holding company or subsidiary company of a credit rating agency registered with the SEBI. So that is a new class, and probably more clarity will come on this because the circular is issued just 2 days back. But if we go through the original proposal, so I will take you to the original proposal. So that is what was proposed in this. So this was the proposal going by the consultation paper. So that is a valuer registered with the Insolvency and Bankruptcy Board of India. So that was condition number 1 and has membership of professional institute by act of parliament enacted for the purpose of a regulation of a professional like a CA, cost accountant or a CFA, and at least 3 years of experience in evaluation of unlisted security and is not associate or a manager or a sponsor, a trustee of the AIF. So that means the this concept of valuation by the holding company or a subsidiary company that is not part of the consultation paper. So that is a new development, and that what is the purpose, we are not sure about that. So yes, madam, question.
Sir, if there is any professional who is just a CA or a CS or a CMA and is into valuation practice, but got IBBA certification, say 6 months back, 1 year back, so they are eligible?
Actually, going by my preliminary view, because I will again say because that is actually in this regard, following is specified. So that is independent. This condition of experience is independent from registration, as you can see. That is part of 8.2, para 8.2 regarding condition of valuation. And this is independent. Independent valuer shall fulfill one of the following criteria. So either he can be registered with IBBI, or it can be independent valuer, which is holding a company or a subsidiary of a credit rating agency. And this is again a different, they have made a slight modification. So I will again take you through this proposal. This is criteria for independent valuer. So that is as per consultation paper. So while a category means that is provided here. So this is the criteria originally proposed. So AIF shall be required to ensure that AIF appoints such independent valuer who satisfied all of the following conditions. So valuer registered with IBBI, has membership, has at least 3 years of experience in evaluation of unlisted security. So here it is not specified that 3-year experience after getting a registration with IBBI. So means my preliminary observation is these are independent of each other, registration and experience, but probably more clarity will come in a future. Otherwise, they should have awarded this 3 years of experience after getting registration with the IBBI. So that is not specifically mentioned. So that actually open for interpretation. So that we have to see how it goes. So any other criteria as may be specified by a SEBI from time to time. So that is open-ended. In a future also a SEBI come with additional guidelines also. So that is about the that is about the evaluation. So eligibility of evaluation. Since time is less, would request you to please throw some light on evaluation method that can be used for AIF evaluation. So yes, I was doing that only. So I hope this at least on this part of a concept of registered valuer, I gave a reply to all the query. If any further query is there, at least regarding eligibility criteria for independent valuer, so that you can go. And now we will go how actually valuation will be done. So that is also provided here. So a manner of valuation of AIF investment that is provided in a circular dated 21/6/2023. So in terms of regulation 23(1), AIF are inter alia required to carry out a valuation of their investment in a manner specified by a SEBI from time to time. So in this regard, following is specified. So until issuance of this circular, there was no clarity on evaluation methodology which can be deployed. So clarity has come just 2 days back. So at the time of issuance of this circular. So valuation of security for which valuation norms have already been prescribed under SEBI Mutual Fund Regulation 1996. That shall be carried out as per the norms prescribed under a mutual fund regulation. So whatever guidelines are issued, and if I correctly remember, that is Schedule 8 of a mutual fund regulation. So in that Schedule 8 of mutual fund regulation, and I will try to locate that from my laptop, and I will try to share after this. But there actually guidelines are issued in a Schedule 8 of a mutual fund regulation. So number one, whatever securities are covered under the valuation norms are covered under that Schedule 8 of or 8th schedule of mutual fund regulation that will apply here also. And number two, a valuation of security which are not covered in para 3.1 above. So that shall be carried out as per a valuation guideline endorsed by any AIF industry association. So this is again kept open. So what actually the guideline will be endorsed by AIF industry association that we have to see actually, because the circular is issued just 2 days back, and which in terms of membership represent at least 33% of number of SEBI registered AIF and the eligible AIF industry association. that shall endorse appropriate valuation guideline after taking into account recommendation of AIF advisory committee of a SEBI. So a manager shall also disclose in a PPM, private placement a memorandum, details of valuation methodology and approach adopted under the stipulated guideline for each asset class of the scheme of AIF. Now here I have a quick observation, a 3-4 observation. Normally we are registered a valuer. We are statutorily actually bound to follow either international valuation standard or the in India actually valuation standard which are notified by the Institute of Chartered Accountant of India. So that is a statutory requirement. That is one of the condition of our registration. We will follow either international valuation standard or we will follow the standards which are issued by the Institute of Chartered Accountant of India. Now here actually it is another guideline is coming up. So this will actually highlight the need for a common regulatory authority for valuation. And as we all are aware, the valuation bill 2020 that is presently pending before Parliament even after 3 years of its introduction. That actually a need is felt. There should be a common regulatory authority because here what type of guideline, evaluation guideline will be endorsed by any AIF industry association that we need to actually see. But I will again draw your attention to the consultation paper. So what was a part of consultation paper? I will take you that. So here actually this para point 5.3, I think it is visible. So issue was deliberated in a meeting. This is relating to need for standardized approach to valuation methodology. So para 5.3 is relevant. So issue was deliberated in a meeting of AIF Alternate Investment Policy Advisory Committee, that is AIPSC, held on October 11, 2022 and November 22, 2022. And taking into account a recommendation of AIPC, it is felt that a standard method of valuation can bring a convenience to the investor, and hence a standard guiding a principle, a methodology standard for valuation may be prescribed. So AIPSC noted that International Private Equity Venture Capital Valuation Guidelines, which is known as IPEV guideline, serves as a standard for valuing investment portfolio of a private equity venture capital, a PE or a VC fund in a various jurisdictions. And considering that IPEV guideline also provide a flexibility in terms of a different evaluation technique with respect to evaluation methodology to be adopted by AI alternate investment fund. So AIPSC recommended that AIF may be mandated to adopt IPEV guideline for carrying out evaluation of their investment portfolio. And then they have described what is IPEV guideline, a market approach. So there are actually multiple of earning or revenue, industry valuation benchmark or market price available for instrument quoted on active market, or income approach based on DCF, or a replacement cost approach based on net asset valuation technique. So that is a latest IPEV guideline is December 14, 2022. So that is available on internet. You may get access to that. But that is now not there. But that is not there now, and they have left it to the industry association. So how that will develop, that we need to see because this is a recent development. So I hope I gave a reply to your query. Any further question related to this valuation methodology?
Sir, if each fund is having 3 different schemes, then we will have to do the valuation of all the schemes separately?
Means that is asset wise, madam. So you are saying one means say a category 3 is holding a different type of financial asset. So naturally that is clarified here. Asset wise different guidelines, asset class wise, different valuation guidelines will be followed. So that is clarified in this circular itself, madam. So
No,
that is
sir, I
how
was trying to say different schemes. Each
schemes.
fund is having 2 to 3 schemes, and each scheme is invested in different types of asset. So what I believe is that we will do the valuation of each asset to arrive at the value of the scheme, and then put together value of all those schemes will give the value of the AIF.
Yes, probably you are referring to a class wise actually. There actually to investor they can give certain advantages to the high value investor within AIF. So you are referring to different classes of investor.
No, sir, I'm referring to different schemes. Each
Schemes
AIF,
means, schemes like
how mutual funds would have different schemes wherein they would have said that a particular scheme would invest only in say startups, and one of the AIF has one particular class of investors collecting money and then putting it only in startups. The other scheme is only putting it in listed securities. So there'll be two different.
Okay, so I understood your question, but actually that is the difference between a mutual fund and AIF. As far as I know, madam, the objectives of AIF means investment strategy of the AIF that will be disclosed in private placement, a memorandum only. And that based on that investment will be made in different types of asset, financial asset. So that cannot be actually different for different classes of investor. So one class of investor only in this startup, as you said, another class only in a financial derivative. So that actually flexibility probably is not there under the AIF. So AIF actually there will be common strategies, madam. That will not be investor-wise strategies. There will be common strategies, but those strategy may include actually investment in a multiple financial asset like commodity, financial derivative, listed equity, non-listed equity, and all.
Fine.
Still any question, madam? Further question?
No, sir.
So just building up on the question, Yogesh ji, if I understand correctly,
yeah, sir.
An AIF will have only one scheme in which the investors can invest, not more than one scheme.
So scheme here means there can be a different objectives. Means scheme is you will invest only in say listed equity. You will invest only a debt security, debt funds and all. So if they have actually disclosed that specifically in their PPM in the beginning, so they will invest, they will go by that. But if they have actually disclosed investment, means multiple investment strategy at the beginning in their PPM, so they will again go by that. And they have flexibility to amend the investment strategy also, but that will require approval from 75% of the unit holders. That condition is there. But means objectives of investment that will be predefined, sir. That can be either one or that can be multiple also, sir.
Okay, so if there are multiple schemes, let us say I can an AIF, they offer 5 schemes. I can either invest in scheme 1 or I can invest in scheme 2 or invest in scheme 5.
So what I will do, I understood your question. So just allow me to take you in Excel. We will understand in a better manner. So I am stopping the sharing and just allow me to share my Excel file. I will take just 1 minute. So actually, this particular there is a means AIF category 3, that is one fund is registered with SEBI, and they have actually a corpus of say 200 crore rupees. So they have that corpus 200 crore, and they have actually declared in their PPM. They will make investment in financial derivatives, then the commodities like say a crude oil.
Sir, sorry, I'm interrupting
Yeah,
between.
please, sir. Please, sir.
See, we fully understand that AIF can invest into 1,000 types of instruments. That's not the issue. The issue is from investor point of view. If I am the investor, I want to invest 1 CR. The AIF will offer only one scheme to me, or they can offer more than one scheme to me.
Okay, so sir, you cannot opt for one particular scheme. That will be common investment. That if you need that type of flexibility, then you need to approach the portfolio management service, PMS, not to AIF, sir. So PMS, you will get that type of
So
flexibility.
AIF will offer only one scheme.
Yeah, AIF, whatever they have declared, either one or multiple investment strategy, that you need to abide by that, sir. It is not that you can insist that you invest
No, I'm not
only for
saying
me.
that, sir. Yogesh-ji, I'm not asking that you tailor-made anything for me. Even PMS does not do that. Even
You gave the
PMS
answer,
does not
sir.
do the tailor-made.
Yes.
But my question is, AIF can offer only one type of schemes, or they can offer more than one type of schemes. If I go, you are AIF, Yogesh AIF 3. They will offer only scheme A, or you can offer scheme A, B, C, D, E.
So I will offer only scheme A, sir. There is
So
no
if
scope
there is
for
only
offering multiple schemes.
Okay, so if there is only scheme A, naturally the valuation can be done only of scheme A, nothing else. That was the only question.
But that scheme will involve multiple financial assets, sir.
Yeah, that is understood. That is understood. Of course, scheme A will invest in 2,000 instruments.
Yes, yes, yes. And continuing with that, so give more information. So what they have done, apart from this, they actually have a procedure of issuing a side letters. So supposing my investment, I means investor of A is limited to 1 crore, and investment of investor B, that is of 200 crore. Okay, sir. So naturally, investor B actually would seek for additional incentive, additional benefit for higher investment. So that will come in the form of less less proportion of management fee, less a proportion of professional fee. So that incentive will only be offered, but different different scheme altogether, that will not be offered, sir. So any further questions, sir?
Okay. Okay, clear. Thanks.
Thanks. So as I can see now, only 8 minutes are left, and we have to a lot cover. So what we will do, we will have a question answer first, and if time permits, then only we will go for a further deliberation from my PPT.
Yes, and especially for gift center, sir, I'll get back to you on this if we could schedule another session.
Okay, okay, okay.
So I request the participants to,
So Gift City, it is called Ocean of Opportunity. So for Ocean, we may require some additional time. So we will do that.
Yeah, so participants are encouraged to, post their points, or this session is open now for interaction. Sir, if any professional intends to take up this NISM AIF course, what you have, already completed in your profile, we could see that you have completed NISM certification course on AIF.
Yeah.
What is the eligibility for that? Like any professional?
Eligibility, any professional can appear. Madam, you need to get a registration on NISM certification website. you can schedule your exam. So once you schedule, you will get this soft copy of course material free of cost. So that actually it is very convenient and means there is no means cumbersome formalities for that. You can very well do. And apart from this, AIF they offer many other courses like the derivative, equity investment, portfolio management service, merchant banker. So that you can always schedule your exam.
Actually, this examination, I was just checking the study, but it has also the valuation aspects. Where how to do valuation of AIF is also a part of the study material of this certification.
Yes, but that will undergo change after actually a publication of circular 2 days back. So that has come out with a new guideline. So if time permits, just give me 1 minute. I will share that Schedule 8 of mutual fund regulation. So just give me a minute. But in the meantime, if any questions are there from participants, I'm ready to take those questions.
So you go ahead and share.
Yeah. Just give me a minute. So this is the, just give me a minute, please. So this is actually 8th schedule of SEBI mutual fund regulation. So a principle of a fair valuation, how it needs to be done. And then we have this valuation guideline. So traded security, it is separate. Then non-traded security guidelines are there. Then actually this unit they are traded. So right share should be calculated as, so how right share valuation will be done. So that is a guideline is covered under this. And this a value of gold, so how that will be arrived at. Then a value of silver, how that will be arrived at. And then means different types of assets are covered. And in case of NAV, a net asset value of a scheme differs from more than 1% due to non-recording of the transaction. So what needs to be done? All these are covered actually in this particular guideline. So this is again available on a SEBI website, and you may download that. Schedule 8 is relevant to evaluation.
Personally, I would like to thank Mr. Ravindranath for suggesting this topic and referring you to BVA. And on behalf of BVA, I would like to request Mr. Anand Kumar to formally extend a vote of thanks for today's speaker.
Good morning, Yogesh. Thank you so much on behalf of all members of BVA. I think this is the first of a kind where all valuers are listening to regulations related to AIF. First time, I believe. So far, we heard everything about valuations, etc., etc. Everyone is into active valuation practice, and we came across a lot of term sheets, SHAs, deals for valuations, where we see these words, funds, AIF, and so on. So this is quite a good session, actually, in my opinion. I was just studied for one of my other clients last week, exactly these regulations. So a lot of doubts also clear to me personally, actually. Of course, it's a very vast area and it might require some more deliberation and discussions so that we can again take up in the next sessions. We can plan it. These sessions not only covered the registration part, but also categories, valuation requirements, and so many other information what you just shared. So I again thank you on behalf of BVA and its members for giving such a wonderful presentation. Thank you, sir.
Thank you. And I express my sincere thanks to each one of you for giving me this opportunity, for your attention throughout the session and making it interactive. Thank you very much.
Thank you, sir.
Sir, on behalf of BVA, we'll be couriering this memento to your address.
Thank you.
Thanks a lot for your time. And request from our participants, please share the PPT and the study materials.
I will do that. I will do that.
Okay. Thank you, everyone. Vijay, you can stop the recording.